Our next guest has been warning the markets are overvalued and says tariffs are a suicide mission that will destroy both labor and equity markets. Delightful. Michael Darda is chief economist and macro strategist at Roth Capital Partners. Mike, not usually one for big, bold statements like that. So I take it you feel pretty strongly.
Thanks for having me on, Kelly. Well, listen, I think if we're using the McKinley tariff period or the Smoot-Hawley period to model economic policy, that is definitely a suicide mission. If you look back to the 1890 to 94 period that spans the McKinley tariff, the labor market failed with the unemployment rate going from 4 to 18%. We had two stock market pullbacks. One was a correction. One was a 30% bear market. I don't have to go through the history of the 1930s for you, but the Smoot-Hawley tariff, which started to make its way through Congress in 1929 and was signed in 1930, was obviously associated with an economic catastrophe that we refer to as the Great Depression. Smoot and Hawley were both run out of office in 1933, forced to recede in embarrassment into private life.
So, Mike, let me just pose the question. I remember, sort of coming onto the beat 20 years ago. One of the things economists always talked about was that the U.S. economy was out of whack. It was 70%, maybe 60, 70% consumer spending. A lot of this was because we over-relied on cheap Chinese imports, for instance. Manufacturing was too small, and so on and so forth. 20 years later, would we still describe these problems as existing and this policy as potentially fixing them, or no?
You have to ask yourself what the mission is here. And we've heard, different goals. And it's been a very chaotic period in terms of what the end game is. But if we're talking about trade deficits, or more broadly, the current account deficit, that really has more to do with the balance between total savings and how much we're spending and investing. I am very skeptical that tariffs are going to be a quote-unquote solution to that unless it's part of a much broader program to reform entitlements and taxes. And we'll have to see about that. Hope springs eternal, but I don't think we're looking at anything breathtaking there.
What you said, and Steve, maybe you saw the headline or the piece in the Journal as well by Greg Jensen of Bridgewater, said the trade war will pound stocks and high asset prices require a large U.S. capital surplus. We don't have that. And so everyone's trying to add this up to say the math doesn't make sense here to have all of these things happening at the same time.
I'm going to say this at risk of my job, Kelly, but what President Trump is doing is insane. It is absolutely insane. It is about the 8th reason we've had for the tariffs. And now he's saying he's putting 50% tariffs on Canada unless they agree to become the 51st state. That is insane. There is just no other way of describing it. And the trouble, Kelly, is that it shows there are no bounds around President Trump. This is very different from the first administration, where there were people around him who seemed to, I don't know what the word is, but smooth over some of the edges now. And the other thing that's not talked about, Kelly, is what's going on within the administration in terms of how they're treating the Constitution and laws. I think all of that is bad for the attraction of capital. And the gentleman from Bridgewater is 100% right. We need massive amounts of capital if we want to fund our deficits, pay for the things we want to pay for, sell our bonds, and have high stock prices. And it seems as if this administration is doing everything it can to chase foreign capital away.